Snapchat's share price has absolutely cratered by over 40%. There was a significant sell-off that flowed from Snapchat to the broader advertising and technology names. Google, Meta, Pinterest. These led to a $160 billion wipeout. And now investors and analysts are asking, is this isolated to the technology sector, or are there implications about the broader growth and macroeconomic narrative? Today we're going to unpack it all. We'll talk about Snap, but we'll also talk about some other earnings and what this means for the broader market. It's a fascinating time, as we can see here, kickstarting off with Snapchat itself. Snapchat down by 43% on the day. It was a significant sell-off. As we know, this flowed out of a release that they provided. They reported earnings just a month ago, but they provided a release that they'd been missing on both the top and the bottom line. And this guidance, of course, really scared the markets. If we're thinking about it at more of a macro level, on the 1 yearly, we know that Snapchat, like many of the technology names, they've not been immune to the sell-off, starting with valuations and the elevated and stretched valuations, then the inflation narrative and the rising interest rate environment hurting those more growthier names. And of course, now we're starting to have the discussions about the growth scare and implications on that front. Just to give you a context of where the SNAP share price sits, it's back at the lows of March 2020, comparable to those levels, but it's also below the IPO price of $17. This is a significant milestone level to break through. So there's a lot of questions about where does Snap head from here. Still trades at a high single digit price to sales ratio, so it's definitely not cheap on a conventional valuation metric on that front. But I'd love to know your thoughts. Drop in a comment below. And what have you made of this whole Snap debacle, but also the broader technology cohort? When we're just having a bit of a flow through here about what were the numbers, what was the discussion, why is there so much fear, uncertainty, and doubt surrounding Snap, and obviously the rest of the cohort too. So Snap plunges by 30%. We saw it close down by 40% after their CEO, Evan Spiegel, warned that they'll miss on both that top and the bottom line, and slowing hiring. This hasn't been isolated to Snap. We've seen hiring slowing across many of the tech names and other companies starting as well. Of course, there are some uncertainties about, are we going to head into a recession? Is there the risk of the policy misstep as well? Will the Fed and other central banks be able to navigate that soft landing? What's notable about Snap's discussion, though, as we mentioned before, was that just a month ago, they provided their guidance and they provided an earnings update, which was actually received fairly well by the broader market. As we can see here, what's significant about it is that the macro environment and the deceleration has happened so rapidly. There's been such a quick deceleration and deterioration. Obviously, there's difficulties getting visibility about where are the earnings and where's the revenue going to be looking moving forward. And as a result of that, while their revenue continues to grow year on year, it's decelerating. Their guidance was for 20 to 25%. They've stated that they believe that they'll be missing the bottom end of this guidance, both on the revenue level, so it's going to come in below that 20% mark, but they also guided for EBITDA of between $0 to $50 million. So they're guiding that they believe they'll miss that on the bottom line as well. You can see here, Spiegel wrote, I think it's likely that they're going to miss that. And this was not isolated. This flowed through in terms of the share price trajectory as a bit of contagion throughout, particularly that advertising-focused technology sector. Meta, formerly known as Facebook, down by 7%. Twitter, down. Pinterest, down. Alphabet as well. And the Trade Desk too. Interestingly here, Snap still to hire 500 new employees, but they're slowing the pace of hiring. And that compares to 2,000 over the previous 12 months. Just to give that contextual backdrop and have a think about where Snapchat's coming into this release with. Snap missed Wall Street's expectations for profit and sales. However, they did grow daily users by 18% more than expected. So essentially what this is stating is they still have the user base, but they had more difficulties monetizing that. And this was with their previous earnings update, but they provided some insights into why that was. Some of Snap's issues, of course, included the macroeconomic conditions, advertisers who are putting campaigns on halt as they want to see how the macroeconomic situation will evolve. We know Apple's privacy changes as well impacted not only Snapchat, but particularly Facebook and Meta because they have more difficulties targeting, which means ads are going to be more inefficient and less conversions. And so as a result here, we can see here, company's overall revenue was still 38% year over year. But as we just talked about before, they're now guiding for the 20 to 25% band, which they believe they're still going to miss now with this new guidance. A few of the other insights as to why. Challenging operating environment, customers potentially pausing or reducing advertising budgets, still navigating the change of Apple's privacy measures on the iPhones, and then talking a little bit into their costing structure. Having a look at where these companies ended up closing the session, Alphabet down by 5%, The Trade Desk, big advertising company there, down by 18%, so they really fell off. Meta, formerly known as Facebook, 7% as well. They've had a difficult year, as we know, but really a difficult past period. They're also nearing the March 2020 lows. They're not there yet, but they're only in comparison after the significant digitization that we've seen in the economy. They're 20% up, but after the peaks from the bottom of the March lows was 150% off. It's definitely been a fall with a range of different headwinds for them. Pinterest, which was a true stay-at-home beneficiary and a virus winner, down by 25%, nearly lost a quarter of its market cap. And we can see here over the 1 year, difficult trudging. Similarly, they're nearing the March lows as well. But I think what was really, really fascinating is, yes, okay, so we've talked about the implications for the broader advertising cohort. We understand it's a difficult period for those there. But there's now been more questions as well about what this means for the growth narrative. It's not often that you see technology companies really diving into, spending a lot of time talking about the macroeconomic picture. But Snapchat, both with their earnings reports and with this new release lowering their guidance, have really talked about that macroeconomic discussion. Obviously, their advertisers, their key customers are going to be affected by this. But we got some more insights last week as well, particularly from Walmart and Target, about the state of the US consumer. We all know that we're in a currently inflationary environment. And as a result of that, obviously, these big companies have got a couple of big choices to make. Do they continue to pass on these rising input costs as well as logistics costs and energy prices and the whole range of inflationary pressures to customers and risk potential demand destruction? Or do they bear these costs? And obviously that will ultimately affect margins and profitability. It's been very interesting to see how these companies have navigated that. And of course, we're still in the early innings. Yes, potentially over the past month, we've seen the rate of deceleration peak, at least for the near term. But of course, this could continue to pick up moving forward. But at this current stage, we're starting to get some insights about how the consumers are really facing with this. And we can see here, in terms of the Walmart and Target discussion, as we know, Walmart said some of its more price-sensitive customers are beginning to trade down to private labels. Home Depot emphasized the resiliency among its customer base. We don't know, coming into this period and out of the virus and the lockdowns, with the strong fiscal and monetary coordinated support, household balance sheets were robust. Though, of course, over time, they will continue to be into, particularly with negative real wages at the scale that they are. Amazon in late April flashed warning signs for the retail industry, booked the slowest revenue growth since the dot-com bust in 2001, second quarter of single-digit growth as well, and a bleak forecast there. And we know that Wall Street expectations were relatively high for Walmart and Target. They are consumer staples. These sector, not only are they much less volatile, but staples, of course, are necessary through high or low periods of the macroeconomic cycle. Walmart missed initially. Share price was down by 11%. The market was waiting to see, okay, is this isolated to just Walmart or is it a sector-wide concern? And then Target missed again and by a larger magnitude on the day after that. And eventually we saw Target down by 25%. And as you can see here highlighted, its worst day in 35 years. So there's now a lot of uncertainties. Of course, we're still in the early innings. There's a lot of unanswered questions. Nobody knows exactly how things will go. We'll have to wait for more data on the inflation front, as well as GDP and growth front as well. We know that the US actually recorded a negative GDP, surprisingly, for Q1. There's uncertainties about how they're going to go navigating this soft landing. How quickly are they going to raise to a neutral rate? And what happens there is there the risk of the slowdown that will continue to grow. The soft landing, the pathway for it is getting narrower and narrower. There are a few different warning signs that are interesting and that analysts and economists are really starting to pay attention to the macroeconomic picture, but we'll continue to see how it unfolds. Drop in a comment, let us know your thoughts. Here are some other videos on the topic that you can check out if you enjoyed this one. A big thank you for joining us. For now, stay well and happy investing.